A long time ago, I was a fresh college grad in the market for my first brand new car. It wasn't the greatest experience as I went to multiple dealerships filled with many unethical salesmen who saw a young girl walk into the building and decided to pounce on her with sleazy sales tactics. After going through that whole rodeo, I finally landed on a Hyundai dealership that was very straightforward, no frills, and offered a promotional interest of 0.99% on their new Hyundai Elantra. I was a perfect candidate for a new car. I had a 20% down payment, spotless payment history. The only thing was my credit score was kind of lacking. When I was about to sign the papers to retrieve my shiny new Elantra, a credit score was run and it came out to 630. The car salesman expressed his worry that my application for the 0.99 promotional rate might not be accepted because of the low score. But he was crossing his fingers, sending it in, and hoping we didn't get a call back saying it was denied. Luckily, I was approved for that incredibly low interest rate, but it just goes to show that with credit scores, even if you seemingly do all the right things, it can still be such a pain to get a good rating. Today, my credit score has improved greatly and has been sitting above 800 mostly for the past few years. I don't mean to share that to brag, more as a way to say, hey, I might know a thing or two about credit scores. Credit and credit cards has been a particular topic I've invested way too many hours of research in. Opened over 30 credit cards, usually dozens active at a time, and I even held a corporate job for a couple years at a top travel company, which I will not name, to do credit points redemptions data research. I want to peel back the curtain some more on what goes into credit, what things you, as a consumer of credit cards and banks, should look out for, and hopefully can help you in some way. My ultimate goal is to help reduce unnecessary debt in people's lives, starting with their finances. From that time long ago when I bought my brand new Hyundai Elantra, my view on credit scores, what it is, how important it is, has definitely changed throughout the years. Back then, the very responsible thing to do was probably to look for a cheaper car, pay for it in cash, and not have to deal with extra debt and all the credit score silliness. But the reality is debt, loans, credit, and credit score is very much ingrained into our society in America. And once you're in, it can be hard to get out. In this video, I plan to get into the nitty-gritty specifically on the myth that closing credit cards or bank accounts in general will hurt your credit score. It will get a bit technical. I will go through every option I can think of, but I think it's important for people to know. If you open any credit cards, you have the responsibility to know the ins and outs of it so you don't get bamboozled, you don't get taken advantage of, and you use credit wisely and have it work for you instead of letting it take over your life. Now, I won't get into what a credit score is and those basics. I'll save that for a future video. The first step for many to get out of debt is to close their credit card accounts. But you might have heard this myth: closing an account hurts your credit score. Is this myth true? Well, yes and no, but I believe people overreact to the yes part that makes them scared to close anything, and that can put them in much deeper trouble than a temporary lower credit score. Let's go through why this myth might be true and ways you can easily mitigate it. Closing your oldest credit card can diminish your credit history, thus bringing down your credit score. So it's true closing your credit card. If it's the oldest, it will bring down your credit score, but having new credit history does not automatically make you have bad credit, and you can still qualify for low interest loans. Little credit history alone will not make you have a bad credit history. You can still qualify for low interest loans with little history, like in my new car example, and a few more years of history can help you get into the very good mid 700s territory, which qualifies for the best loan rates. Just 2 years after my 630 credit rating, I applied for a mortgage and my score jumped to 760 by then. And I was able to score the best loan at the time for a 2.5% ARM. My advice on if you need to close your oldest credit card, only close it if it has an annual fee. And only close after a year, or better yet, downgrade to a no-fee card. Or even better yet, always have your first card be no annual fee. And if you don't use it, make purchases 1 or 2 times per year to keep it open and active and prevent automatic closures. I'll go into the downfalls of automatic closures and closure alternatives later. Closing accounts can bring down your score by decreasing your credit available, thus increasing your credit utilization. Credit utilization, or amounts owed, accounts for 30% of your credit score calculation, according to myfico.com. This is the second highest factor right after payment history, so it is definitely something to pay attention to. And if you do closures wrong, your score can drop over 60 points because of this reason alone. But the great news is that if your score does drop because of high utilization, it's very easy to recover from it, and you can bounce back within a month. A great utilization rate is 0 to 3%. 10% is bad utilization, and everything in between is okay, but I would still try to keep it under 3%. That means to get a higher credit score, you can't have your total amount owed across all credit cards be higher than 3% of all credit available combined. Otherwise, your score will start to dip until that utilization is lowered. Let's take, for example, a similar thing that happened to me recently to put this into perspective. One of my credit cards had automatically decreased in available credit line from $11,000 to $1,000 after I did not use it for a year. This is normal for banks to decrease credit or even close cards automatically if it lays dormant for a period, usually 1 year. Imagine if I just had one other card with $9,000 balance and I consistently reported $1,000 per month statement balances. My utilization, without warning, went from 5%, which is an okay rating, immediately to 10%, which is a bad rating, and can decrease your score instantaneously by more than 60 points. I'll give another example that happened to me recently that's kind of related to this. 1 month this year during the summer, my utilization went to 10% after it was consistently at 0 to 3%. My score immediately went from 800 to the low 700s. I was pretty shocked that this happened, but this goes to show that credit utilization is a big factor in calculating your score. Luckily, I was quickly able to bring back my utilization to 3%, and it immediately rebounded back to the 800s. So it does decrease your score a lot, but it's really quick to rebound when this happens. Now, I know that all sounds pretty alarming and scary, but don't fret because there are easy ways to avoid this altogether. One way is to pay off your credit card balances across all accounts to 0 before statement close dates, or keep your utilization under 3% for optimal scores. If you have any big purchases that you know will bring this percentage higher than that, make sure to pay off as much as you can or all of it before that statement close date hits, so the high utilization is never reported. Okay, the cards I want to close aren't the oldest, and my utilization will still be very small, but won't it still hurt my credit score if I close either way? The answer is it depends. But if it does outside of the two reasons listed above, it's very minimal. Closing one or two cards probably won't move your credit score at all, but closing many, like 4 or 5 plus, can dip your credit score by maybe 5 to 10 points and might show up as a reason your credit isn't higher when applying for loans. But usually the score rebounds back within 1 or 2 months anyways. This did happen to me when I applied for my mortgage loan. The report stated I closed too many credit cards in the past 2 years, but my lender assured me my 760 credit score still qualified for the best rate and my higher credit score would not help anymore. So take that what you will. If I were to do it again 2 years before applying for a mortgage, I would close all my active annual fee accounts at once, put a hold on any credit card or bank account openings or closings during that period, so my credit history can appear spotless. But if you cannot do that, it is not a big deal. Okay, what about canceling within a year after opening accounts? Yes, canceling within a year can hurt your score too, but the rebound is quick within 1 or 2 months again. The things you should look out for most when canceling within a year is your eligibility for those lucrative sign-on bonuses and your relationship with the bank for future cards or accounts you might want to open. My ultimate recommendation on closing credit cards if you are wanting a higher credit score is if you need to save money, make a plan to close or downgrade all cards with an annual fee after a year. It's not worth it to keep those just for a slightly higher credit score, which bounces back fast anyways. And keep all other cards open for as long as possible for credit history. And also, never close your oldest account unless it has an annual fee. Alright, so I came up with this 3-step checklist for canceling credit cards. First step is to wait 1 year until the card or account has been open, but no more than 30 days after that 1 year. Usually this is when the 12th monthly statement has posted, and if your card has an annual fee, wait until that yearly fee is posted. Then call the customer service line on the back of the card, and the credit card rep should be able to close your account and also refund back that yearly fee as long as you've called them within 30 days of it posting. If you want others to prevent using your card but can't close it just yet for security, many banks have a freeze card option, which you can enable from their mobile app or calling customer service. So the first step was waiting a year. The second step in this checklist is to pay off all balances of the card that you're closing at least a few business days before posting to have the payment finish processing. This is important so you don't have to deal with worrying about a balance still due on a closed account. The third step for this checklist is, if you can, pay off all balances of other cards, or at least bring balances down to very minimal that you know the total utilization after closing will be under 3%. This will prevent you from having a lower credit score because your utilization will rise. I do want to mention 2 alternatives to closing an account that you can also do. The first is downgrading instead of closing to a no-fee card within the same bank if you're wanting to eliminate that annual fee. I've only done this a few times after opening 30 plus cards. It doesn't show as credit closing, doesn't impact your credit score negatively at all, and can contribute to a longer history. The second option is to combine balances to existing cards in the same bank. Note that this is combining with the same bank, which should not charge any fee for this. And this is different from debt consolidation, which I highly warn people against using, and you can get into a lot of trouble this way. Combining balances with the same bank is a great way to avoid the credit utilization trap and less chance of automatic cancellations from the bank as well. Now, this is all if you want a higher credit score, but we must remember the only reason we really need a high credit score is to take out more loans easier, aka get qualified for more debt. So, if you're on a debt free journey, maybe the best thing to do is ignore all these little rules and nuances I listed and just go ahead and close that darn credit card. Every impact is minimal or very temporary if you're contemplating closing out your credit cards to get out of debt. It is a personal finance journey after all. No matter what you do, now you know there's a couple options you can take. As for me, I'm currently striving toward a debt-free journey. I've successfully paid off that first car, which I still own and drive today with over 100,000 miles, successfully paid off my undergrad student loans, and am working toward paying off my mortgage within the next few years. Hopefully, crossing my fingers. Thanks everybody for watching, and would like to learn if you guys found this helpful at all. I have a lot more topics about credit score and credit cards I do want to talk about as well, and just finance in general. Thanks for watching and listening.